Hey, what's up guys? How's it going? Right, I'm going to try and cover everything in this video. So the title of this video is Trading, Investing, Everything Everywhere All at Once. So what am I going to cover? I'm going to cover narratives and market tone, inflation, rates, recession, front running, then going to talk about traditional finance, all the stuff in TradeFi, US Treasuries, dollar, stonks, gold, commodities, oil, global equities. Then look at crypto specifically and also touch upon NFTs at the end of it all. So I know it's a really long video and you're probably wondering, is it going to be worth your time? Trust me, this is going to be really good, and this is the only video you're going to need for the next few months. I'm going to be covering all those topics, but not only that, but I'm going to be giving you entry and exit levels, where to place the stops, if else scenarios, alternative scenarios, and also towards the end I'm going to cover some altcoins that have got the potential to do 10x. They're not your little minnows, but they are actually recognized names which haven't done so well as yet, and they have got a good kind of narrative, good kind of story behind them, and they could really rock it very quickly. They could be the next Zilliqa or Waves. Okay, so those are the kind of things I'm talking about. So stay tuned and enjoy the video. Let's start. Right, narratives. What are narratives? They are the underlying story, underlying factors that drive the price of all the other securities. Inflation is the underlying narrative. Inflation is going up, which is causing rates to go up, which in turn is causing repricing of all other assets, especially risk assets. Okay, there's a lot of talk of recession, a lot of negative headlines, and so that's really the key. The inflation is at the root of all of this. So let's have a look at what inflation has been doing and where inflation stands today. One of the sites I really love is this tradingeconomics.com. They have so much information, all of it's free, and you can get really sort of long-term charts on all sorts of things. So check it out. Let's look at the US inflation rate. Let's zoom out into the maximum data set that they've got, and you can see this chart which goes all the way back to 1930s. You can see exactly what the inflation rate has been doing during all of that time. Now it went up, it sort of peaked in 1980 when Paul Volcker killed inflation, and it's been sort of trending downwards ever since. And in fact, in the last sort of 2 decades or so, since 2000, that sort of time, we've been fighting deflation. In fact, in 2000, the Great Recession, we went into deflation briefly, and then we've been kind of, sort of trading around that range, and not trading, just kind of hovering around that range, and there's been risk of deflation. In fact, all the Western banks, the US Fed, the European Central Bank, and also the Japanese bank have been fighting deflation for quite some time. So what's happened recently is that inflation has shot up. And what is very interesting and very key is that if you notice these two peaks here, that one and that one there, inflation has gone past those two peaks. It's broken out to the upside. And so now I think that confirms a long-term secular trend in inflation rates. I think inflation is here to stay. This is the thing that we've been fearing for quite some time, with all the printing money and all that kind of stuff. And finally, we have got the inflation is broken out, and it will, it has entered a new kind of upward cycle, a long-term upward cycle. Now, how long that is anybody's guess, but certainly years to maybe even decades. Okay, so when you look at how inflation rises, I mean, you can see here that from this low, from this high, it's what, 1950, 680, that's 30 years. Okay, so will this phase of inflation be that long? I don't know. But what I do have a great deal of certainty of is that we have entered a new phase in inflation, and it will be trending higher or remain elevated for a long time to come. What is likely to happen in the kind of in the next few months to maybe a year or so is inflation is going to come down to maybe 5 and find support there, and then it will rise again. And when it starts to rise again, that's when I think shit is going to hit the fan, because that's when everybody will realize that inflation is here to stay and is going to be bad for much longer than anybody thinks right now. Because right now, I think the market feels, the Fed feels, everybody kind of feels that inflation will be tamed by higher rates, and inflation will come to a more manageable level, and we can carry on with our merry ways. We can have good growth, good employment figures, and manageable inflation. But that will all be put to test when inflation comes back to 5 and then rises again. So over the next few months, as inflation comes down to 5%, everything will look hunky-dory. It would seem as if the Fed has managed to tame inflation and we are in a Goldilocks scenario. And so everything may pop then because of that. Okay, so that's the inflation scenario, and that's the underlying theme narrative that's driving everything at the moment. Okay, so let's look at where rates are. So let's look at the 2-year. That is the most sensitive. Just have a quick glance at the 2-year, 5-year, and the 10-year. Now, one of the most important things you can see here is this trend line here. That's been in existence during the whole downward leg of rates, and you can see that also in the 10-year, nice trend line. In the 5-year, which is, no, that's the 10-year, so that was the 5-year I just showed you earlier. So nice trend line where price kind of reacted from and never really broke out of. And again, we are at that trend line now. And I think given all the background, given what we've seen with inflation breaking out, I think this trend line will break this time, and that will also then confirm a secular trend change in rates. What I'm also expecting for it to do is take out this high here, which, these major highs have never been taken out previously. I mean, I know this one has been taken out, but if we look at the 2-year or the 5-year, the highs haven't really been taken out. Significant highs haven't been taken out. So I'm expecting this significant high to be taken out meaningfully. And again, that will be another sort of confirmation that we have entered a long-term upcycle in rates. Okay, there's recession. There's a lot of talk about recession at the moment, a lot of headlines. Let me have a sip of my tea. There's a lot of talk of recession at the moment. How does, and talk of the curve inverting and all that kind of. So this is the 2-year. This is the 10-year minus 2-year. This is the most significant one that everyone talks about. Well, we can see that it kind of inverted there. We didn't get a recession. It's inverted again here temporarily. It's moved back up into positive territory, but it has some ways to go to reach the lower end of this this range. I mean, you can see this also kind of ranges. The upper limit is there, lower limit is here. So we've got some ways to go, and especially now that it's also moved into positive territory, we've got a few months of it going down and maybe reaching these kind of levels, and that's when we'll be kind of, that's when you really have to be worried about recession. And again, when that happens, typically recession doesn't occur straight away. It occurs 6 months to a year and a half later after that occurs. So we've still got ways to go before we get a recession. Okay, so recession isn't likely. What is obviously on the cards and has been priced in to some extent is the rate rises. Okay, and that's what's going to impact risk assets, not necessarily Well, recession will, but what generally happens is when recession actually hits, that's when you see a bottom in prices. So the markets tend to sell off well in advance of the recession, and when you actually get recession called, then you tend to find the market then bottoms and then it starts to climb up. Okay, let's talk about front running a little bit. What do I mean by front running? Well, smart money always likes to anticipate what's going to happen, and you probably heard the saying that markets are forward discounting. They price in what is likely to happen before those things happen. So if we look at the 2-year, we can see clearly that the 2-year rates were telling us that inflation was going to be, let's go into log again, was going to be bad. Okay, look, let's go on the daily. We can see that rates kind of bottomed, blah, blah, blah. And then you see this peak here, it broke out there, and then it broke out again there. And then it did a retrace. And then since August, we've been on a upward trajectory in rates. And we can see the same thing in the inflation metrics. Okay, so it's that's September. September it started to really climb up, but the 2-year started to climb up in August. So it was foretelling what was going to happen in inflation. So inflation goes up, but the bond market tends to anticipate the inflation is going up, because the guys that run bond funds and bond money is more long-term money. They tend to look at what's going to happen 5 years, 10 years down the road, and just try and price those things. They're always looking into the future, and so it tends to front run everything else, and it can be quite a reliable indicator of in terms of what's going to happen and everything else. So that's that. On a more recent time zone, we can have a look at the Nasdaq. So the Nasdaq topped out in November, and so did the crypto market, and that's when they started to factor in or price in interest rate rises. The first interest rate rise in March was beginning to be priced in then. Now, interestingly, the stock market didn't sort of react to the anticipated inflation readings. Inflation started to climb up, like we just said earlier, from August really, really markedly, and yet the market carried on going up, because the stock market tends to get as much as it can while it can get it, basically. So there was still good earnings to be had, even though inflation was running hot, and even at this kind of August, September time, some market players probably thought that higher rates were coming very, very soon. Higher rates were coming a few months down the line, but they thought, right, okay, yeah, higher rates are coming maybe in about 6, 7, 8 months, but for the time being, for the next 3 months, we can still enjoy good dividends, we can still enjoy good growth, we can still enjoy upward stock prices, so let's stay with it. Okay, so I think that's how the stock market sort of plays it, because here in the stock market, you're looking at getting dividends and things like that, and so it plays to sort of not be too ahead of the curve, but just to play what's kind of immediately in front of you in the next sort of 3 months or so. But obviously once we got to sort of November, once it was kind of certain that in March we would get rate rises, well, then the market started to sell off, because the risk of rate rise and the effect of the rate rise was higher than what you could potentially get at that time from dividends and things like that. Okay, so then it started to play. And so what do I mean by front running? Again, let's have a look at what happened. So the market sold off, and lo and behold, on the interest rate rise day, the market finds a bottom. Okay, so it's, in this case, sell the rumor, buy the news. So buy the event. When rates moved up, that's when you started to find the bottom. In fact, this bottom was found when we had the beginning of the war, because if you remember, when the war was starting, there was a lot of negativity, what the war would do and all that kind of stuff. And in fact, that's when the market found that low. And after that, it found low on interest rate day. So they anticipate what's going to happen and they sell off. And typically you find that it's the sell the news, sell the rumor, as it were, and buy the news. So that is a very, very important and very useful thing to keep in mind. So in the same sort of way, we've got another rate rise coming up in May, which is going to be 0.5%. I think that's already guaranteed. And so I think the market is looking to sell off until that date, and then it will find a bottom then. And I'm still thinking that this low will hold, and the low that we find in early May is going to be of a higher low, and we could then push up from there. Because the amount of negativity that's been kind of priced in, every headline is a recession headline, every headline is about inflation, every headline is about rates increases, whereas inflation is already, you know, well into its high figures, and we'll be looking really at topping signs in inflation. I mean, I don't think, you know, it's topped yet. Looking at the trajectory of inflation, you know, the rate of increase of inflation is still steep, looking at this line. And so you'd want to see a slowdown of that and maybe a curving of that before it rolls over. And so that would be the peak. So if you just kind of extrapolate, and let's just imagine that it just kind of rolls over here. So you're still looking at maybe a couple of months of upward move, and maybe inflation peaking in June. Okay. So if inflation peaks in June, inflation comes down, well, that can only be good for markets, because the market will start to, you'll hear a lot more good news, and then good news, you'll start to sort of, as you get more and more inflation figures each month, you'll have better headlines. And when the headlines become quite euphoric that we have nailed inflation and we can go back to our merry ways, that's when you should be panicking, that's when you should be worried, that's when you should be selling. Okay? So that's how the stock markets will play out. Now, the bond market, on the other hand, in this instant, it's not indicating it's peaked, either because it wants to sort of break that trend line and also break that previous high, and also because the bond market will peak, I think, when it front runs the peak in rates by maybe 6 months. So if we assume the rates are going to peak, say, in December, let's assume that inflation peaks in June and starts to come down, and obviously then the Fed sees that the medicine's working. Then we could get a top, a mini top in the rate cycle, say end of December. Well, then that would allow the 2-year to sort of top out 6 months ahead of time. So 2-year may top out in June as well. I mean, it may react from this trend line, because this trend line has been on since the 1980, and it's been very, very strong. It's been tested multiple times. So it's quite likely that it won't be able to break it on the first attempt. Although if we look at the 5-year, it has already broken out. Okay, but the 2-year and the 10-year haven't. So the jury's still out. It may be able to break on this first attempt, or it may come down, backfill a little bit, and then make another attempt to break the trend line and this top decisively. So anyway, so we'll see how that plays out. But I think the key things to take away from this is that inflation's going to top out in a couple of months. Rates have probably got some ways to go before they top out. Stocks are going to see a bit of pressure going into rate rise, and then we should see momentum building up. Now let's have a look at, so we talked about front running, we talked about recession, to all the negative headlines. Now let's talk about dollar. Okay, dollars. So where are we? Now, you've probably heard the saying that there's money to be made. Something is always going up, all right? So now that we've got stock selling off, bond selling off, where is the money going to? Well, what happens when you sell something? Well, you either you put your money into something else, or you keep it as cash. Okay, so there's two places where it seems to be going, and it seems logical that it ought to go there, in dollars and in gold. Okay, unless if we see a strong move in equities, then we could probably see a move out of dollars and move out of gold. But as it stands, dollar still seems to be sort of trending up. Now it's very, very close to, I mean, it's at this resistance level at the moment, but I think, you know, it could possibly break that or maybe stall there for a while it gives some chance for equities to move up, or it could go to that trend line and then move down. But the dollar, yeah, it's kind of almost near its sort of local top there. Okay. Let's have a quick. Okay, let's look at gold. What is gold showing us? Well, gold is giving us a very, very good picture on its chart. So it's got the good chart formation behind it. It's got the narrative as being an inflation hedge. It's got it's got all that going for it. One thing I'm a little bit surprised about is the fact that gold hasn't reacted far more than it has done. It hasn't gone up far more than it has done, because we've had inflation really going up, and if we're expecting inflation to come down, then obviously that would impact gold negatively. The other thing is negative real rates. Real rates have been getting more and more negative because inflation has been rising a lot faster than rates have been rising. So why hasn't gold reacted much more, and is it likely to come down because inflation is going to come down? Well, I think not. I think what's happening here is that gold is behind the curve. It seems as if gold is still catching up to inflation. Because gold didn't react so well. No, sorry, let me just go back a bit. Yeah, so I think, yeah, it's behind the curve. So I think the move in gold is yet to occur properly. And looking at the chart, I mean, look, it's moved up and then it's done a kind of a rounding bottoming formation there, and it's moved up. When you get things like that, you only get acceleration in the price move up. So I'm expecting gold to move up and start to price in what inflation has already done. Okay, it's just behind the curve. Now, for a more sort of short-term picture, here, if you're wondering what all the vertical lines are, they're lines when inflation reports came out. So just try and ignore that. But let's just look at gold. I mean, here it's formed a local top here on really high volume. Okay, that was when oil was peaking and there was a lot of fear with war and all that kind of stuff. And since then, it's kind of retraced back. So I think this top is likely to hold for a couple more months yet. What you find is that gold and silver retrace and backfill for about 3 months before they make another attempt at the previous local top. So I think this is what it will do. It's doing very well. It's got a very constructive chart pattern already, but I don't think this high will be taken out for at least a couple of months. What it might do, and what it seems capable of doing, is actually doing this. If you look at my squiggly line there, it's moved up above this resistance area and now it's coming back, backfilling, settling down, and I think it will then push up and maybe try even get to this trend line here. If it does, then I will exit some of the positions, expecting a move down and then more kind of consolidation before it can have the sort of capacity to move up and take this high out. Okay, silver in the same sort of same way. Gold and silver, I don't really have a relative position, but I think just eyeballing it, I think gold is going to outperform silver over the next few months. I mean, in the next couple of weeks or so, maybe silver will outperform. In fact, I have very equal position on both of those, but I will be moving more money into gold if we see this chart, this gold and silver ratio chart coming down to this trend line. Okay, so that's that. Oil. Oh, let's look at to get a bit more of a perspective on stocks. We've looked at Nasdaq and what I think is going to happen there. Naturally, SPX and Dow is doing the same because they're all kind of correlated. Let's look at stocks, all stocks other than US. This can be a leading indicator because this composes of the rest of the world except USA. Basically, it's got all the developing countries and emerging economies and things like that. So it tends to sell off well before the mature markets do, US markets do, and lo and behold, you can see that it topped out in June, whereas the US markets topped out in November. Okay, so it's always worthwhile keeping an eye on this to see what's happening to risk assets. I mean, these are more riskier on a relative basis, and therefore they sell off, and money tends to flow into qualities. And then obviously when the big bear sort of starts, even the quality names, the Dow starts to falter as well. Okay, so that's that. Oil, I'm not really going to bother with oil. Well, no, let's have a look at oil. Where are we? What's this? Yeah, crude oil. Okay, we need to go into a linear chart because that was just like absolutely ridiculous. When it goes below zero, log charts don't work anymore. So look at oil. Look at what it's done. Yeah, so this is where it's negative. Now it's gone above this high here. Now that's quite significant. I think it's put in a significant high here, and I think we will see backfill for a few months. And as inflation comes down, I would expect this to come down to perhaps this level here, because this support hasn't been tested yet. If we go into the daily, we can see that this line hasn't been tested. So I think I would expect it to trend down and test this line. What is that? That's the VIX. Commodities. Let's look at commodities. Where is commodities? Commodities, SPX, SPG, gold commodities. Yeah, commodities index. Yeah, again, it's literally the gold chart. Again, it's going to do the same thing. So all kind of commodities will kind of start to come down a bit as inflation, and obviously that will in effect lead inflation down. Okay, now let's go lastly to our favorite topic, which is cryptos. Where are we in crypto? The chart that I really like to look at right now is Ethereum chart, because that seems to be cleaner. Just to get overall perspective, let's do BTC. All right, let's do BTC. Okay, looking at BTC, it seems like what we've been going through since April of 21 is a consolidation. Okay, it looks a classic consolidation. If we take this bottom here, 15 December 2018, after the big bear, then we can clearly see one impulse wave here and then a large retracement. I think the retracement would have ended there if it wasn't for the black swan event of COVID. You know, it kind of turned, and I think it was going to head up, but then COVID struck and then we came all the way down. Okay, but clearly it was an impulse wave there and a correction move down, and then another impulse move, and then now we're getting another correction. Okay, the question is, how will this correction play out? Will we get a bounce? Have we seen the lows, and are we just going to carry on going up? What sort of correction is this? Now, corrections can take all forms. These kind of horizontal consolidation corrections, they can be like this, goes up above that high and then comes back down and actually takes out the low, or it can be goes over the high and then it kind of like finds the bottom higher as well, or it can be very symmetrical. Okay, so it can be anything. So the jury's still out as to what it is, but looking at the narrative, looking at forward pricing, looking at how much negative news has been discounted, looking at where we are in the inflation cycle, I think you know, crypto, this bottom in crypto should hold, and we should see this line, this move up. But you know what, we can quite we can confirm this. This will be revealed to us very, very soon, because if we look at the East chart again and then really kind of go on a shorter time frame, we can see two things. One, anyway, let's just do a little bit wider time frame. I think we need to go on the daily. We can see that there's a trend line on ETH, which is from that bottom and which has been respected by these moves down. Okay, and now we are testing that line again. Now in crypto, if a trend line breaks, if a confirmed trend line breaks, which this is, then it most of the time indicates a trend change. Okay, so if we break this trend line, this yellow trend line, then I think we are heading down. I think we haven't seen the bottom yet, and you know, I wouldn't be too surprised to then see price coming down to this level, ETH 1700, 1650. I know it seems ridiculous, but we can get there very, very quickly. Okay, it's happened before, it can happen again. And on BTC, we could see these lower figures. We could even, you know, we could even with this correction theory, we could see prices going down to the previous all-time high of 20,000, even down to here, and it will still be correct. I mean, like I've drawn here, it could come down here and then it can go up. So anything can happen, but for the time being, what's the way to play it is really to kind of hope and play for this trend line, this yellow trend line to hold, and if it holds, then merrily we go, and if it doesn't, then we get out and we see what happens, and we expect maybe the bottom of this trading range to be hit, and then if it does, then we load up big and retry. Okay, so that's what I'm expecting on crypto. Chart forms are one thing, but you know, like we all know, they can fail, and they do fail a lot of the times. So volume is a very, very important confirmation tool. Volume can tell you whether it's going to fail or not. And you know, if we look at volume, I think it's been quite constructive. We've got a low volume downward move right now. Sorry, we've had a low volume move up. Let's go on the daily. Here we can see we've got a low volume move down. Well, to be perfectly honest, it's probably not that conclusive, but this trend line is, and I think there is a volume drying up, and so what you should be looking at is volume drying up even more as we approach that trend line, and then you can go big. Okay, with a stop staggered below the trend line. Don't put it just under the trend line, because that can sometimes be hit and then the price rallies. So maybe stagger them, maybe take some out here, take some out there, take some out there, take some out here, and put some well away from reach, as it were, and that way you'll be far safer from those stop hunting wicks that you get, but obviously it will mean a greater loss, so you need to sort of plan for that. Okay, so that's crypto. Now let's just have a little look at alts. We haven't had any leadership this time. We've had the L1s in the last cycle. This cycle is all about the L1s and metaverse. They 10x'd and more and some. In this one, we haven't seen that. In this cycle, right from the off, we had NFTs absolutely exploding. We had L1s, NFTs exploded first, then L1s, and then metaverse. We've had three major things, and then obviously we had Axie Infinity at the early stages as well, absolutely exploding. Have we had anything similar here? The only two I can think of is basically Zilliqa and Waves, and they haven't really provided great amount of leadership. They really pumped up high, but nothing else is kind of, you know, we haven't had a whole big sector of things moving, just two isolated examples. And Zilliqa and Waves have kind of maintained some of their some of their price appreciation, which is comforting. Let's have a look at Zalika. But we haven't seen any other kind of leadership, so that's a little bit of a worry. But it could well be because this is ETH time now. ETH is going to outperform. But there are a couple of ones I'm looking at which I think, if we are in a sort of bull phase, then we can actually, these will really, really do well. And APE is one of them. I think APE is shaping up. Well, the chart looks very similar to the charts that we had for Doge and Shiba, where it kind of does this kind of move and then it settles down, and then the oscillations narrow, the volatility narrows, the volume dries up, and then you have a massive shoot up. So I think this could quite easily over the next 2 weeks start to sort of climb up, and within the next sort of 2-3 months do 10x from around about this sort of figure. So we're looking at 17 to 90, sort of 90, something like that, if not more. Okay, that's one I'm looking at. There are others I'm looking at, which is Boba L2 play. We may get a meme 2022 for L2s. CHZ, I think sector specific blockchains might do well, and this is really on the basis of two things. One, the shape of the chart, down, up, down with a new low, and the fact that it's sector specific. It's into NFTs, gaming, and entertainment. That's why I'm thinking maybe it will follow the same kind of price move as Zalika, because Zalika's pump really came from the news of its involvement with some metaverse thing. Okay, and again, it's got the same kind of start structure, a large corrective move with 2 waves down, and so I'm hoping and I'm thinking that Chiliz is going to do that, and also Theta. Where is Theta? That's Theta fill. Theta, yeah, again, that's got the same kind of structure. Can you see? Same kind of structure, down, up, down, and then maybe a breakout, maybe a massive shoot up. Okay, so that's what I'm playing for. Again, Theta is also a sector specific one. Last cycle we had the generalist blockchains, L1s. This time I'm thinking L2s and the sector specific ones. Another one I'm following closely is VET, purely because of, again, it's got the same sort of structure, and also because if we look at the ETH crypto charts, VET and ETH, then look what it's been doing. It's been coming down to this lower kind of price range, and it's been shooting up. Now, this may be different. It may come and break that. In fact, it's just kind of taking the lows. So it may break that, it may not work, but just what if it does work? Okay, I don't want to be looking back if it does something like that. I don't want to be looking back thinking I had this amazing opportunity, low risk opportunity to try this out, and I didn't. So I am in this. I'm hoping for something like that, but obviously if it breaks down, then I'll be getting out. Now, when you think ETH is going to outperform BTC, then what you need to be doing is charting every other coin against ETH and seeing if any other coins can do better than ETH. Okay, if they do, then that's where you want to be. You want to be in the fastest horse, as it were. Okay, so this looks to be like the fastest horse. Time will tell. Just quickly going back, so those are the odds I'm looking at. Just quickly going back on the ETH BTC, I think it's time for ETH. Okay, we've had this kind of meandering consolidation around here. Up until that sort of point, this move on this side was kind of replicating the move on this side. If you have a look at where things top out, you've got this kind of cluster of tops over here, you've got a cluster of tops there. It's not exact, but you've got a bottom process here, you've got a top over here. So it's been kind of mimicking what's been going on this side. So now we'd expect it to mimic this move. So a move going up to that line. And given all the sort of development that we've seen with ETH, we would expect it to reach at least this kind of levels, since it did that in the last cycle when it was completely new and none of these kind of DeFi and NFTs and all that kind of stuff weren't even around then. So we would expect ETH to outperform and reach these kind of levels against BTC. So it's been under the cush for a while, and but I think now is the time for it to sort of break out, and it's showing some indication of doing that. I mean, this consolidation area is a very nice consolidation area. You've got volume drying up really, very significantly, and at these kind of lows, the volume really dried up, and now we're seeing volume pick up. It's not significant, it's not that noticeable, but the volume drying up was very, very slow. So I think volume picking up will be light, and suddenly it could just, as soon as everyone kind of FOMO's in, it could really, really spike. But you can see a little bit of a trend there of upward volume as ETH outperforms BTC as this chart moves up. So I would expect ETH to outperform. Plus, this kind of move down here is a bit like a pennant, and then when they move, they tend to sort of, do a similar move to that, and that's what I'm expecting, and that's what I'm hoping for. So ETH BTC, ETH is going to outperform, and VeChain, I'm looking for it to outperform ETH. So VeChain is where a lot of my funds are. ETH is where a lot of my funds are. I've got absolutely nothing on BTC. I've got some in Ape, and I've got some in a few other sort of alts. So just to sum up, inflation is coming or very near its local top. Then we should see it decrease down to 5%. While that happens, markets should rally, thinking that the Fed has tamed inflation and we could get reasonable growth with reasonable employment figures, and everything is hunky-dory. So now, currently, the narrative is higher rates are good because it will kill the demon that is inflation. And as inflation comes down, we all become really, really happy and jubilant. And then when inflation starts to pick up again, after it's revisited 5%, that's when markets really sell off on a continued basis, and we could be in a bear market in all kind of risk assets for quite some time. For crypto is following the traditional markets until proven otherwise. So there's only two ways that crypto can go up. One, if traditional markets go up now, like I've just outlined, or if crypto disassociates or decouples from traditional markets and regains that inflation hedge label again. And if you can do that, and if you can decouple, then put all your money, rob a bank, do whatever, get money from your grandmother, whatever you can, and pile all your money into crypto and gold. Okay, because you never get a decoupling market. If you get a decoupling market where you've got two huge kind of areas where you can put the money, you can bet your bottom dollar when money flows into those, they are going to absolutely rocket. In that kind of scenario, you can see Bitcoin going to 200, 300,000, and gold, going to 8,000. The second scenario in which, well, actually, it's the first scenario in which crypto can move up is if traditional finance moves up. And if traditional finance moves up, then crypto has got a small window of opportunity for it to move up. And Bitcoin can get to 100,000, maybe not much beyond that. And it's only got a limited time to do that. And that is until, inflation hits 5% and starts to rise again. So you're looking at maybe 6 to 9 months and maybe a year. And that would actually coincide with how the overall sort of structure of Bitcoin is. So if we kind of say that this bullish move, if we get it, is going to be the last move of this 5-wave cycle, and then we get the mother of all bears, real crypto winter, then this kind of corresponds to how the inflation story in traditional finance story is going to play out. So I don't think crypto is going to be able to, or Bitcoin is going to be able to get the inflation hedge label just yet. And I think it will follow the traditional finance and it won't decouple from that. Okay. Oh, NFTs, quickly NFTs. There isn't a lot to say about NFTs. NFTs just seems to be people just passing money around, and the only beneficiaries are literally OpenSea and their investors. Just stay away. I mean, there's three main issues with NFTs. One, we don't have a long price history to be able to gauge where the sort of buying and selling pressure is, where the support and resistance levels are. Secondly, you have to sort of commit a lot of money to these. You either buy it whole or nothing. It's not like just buying, buying slowly. With coins, you can buy a few and you can buy, you can average cost. You can get in, get out quite easily, quite cheaply. Third one is the round trip cost, buying and selling. You've got Ethereum fees. You've got OpenSea 2.5% fees. You've got fees going to artists, and so when you factor in all that, you're down 5% as soon as you press the buy button. Okay, and then the other factor is, can they do 10 bags? Okay, is the reward worth the risk? And NFTs, completely no. I have played it, I've made some money, lost some money. Overall, I'm a little bit up, but really, they're just an insider's game, and they're really a game that's been played by OpenSea just to generate more sales. And you literally just see something going up by a few percent, and it comes back down by the same percent, and then something else going up by. But they haven't really had any kind of move apart from Bored Apes. Bored Apes are the only one that's done well. Every other NFT project has not done anything since last sort of August, when things peaked and when things were really, really buoyant. Okay, and that wraps it all up.